Good morning, everyone. As we navigate these turbulent waters, it's becoming increasingly clear that geopolitics is no longer a peripheral concern, a mere footnote to economic data. It has asserted itself as a primary, often unpredictable, force shaping global markets and investment decisions. Today, I want to take a deep dive into how these tensions are manifesting and what they truly mean for our financial landscape. We've recently witnessed a stark reminder of this with President Trump's new 15% across-the-board tariffs, igniting a classic haven bid that sent treasuries soaring and stocks sliding. J.P. Morgan's Priya Mishra articulated this perfectly. With uncertainty, investors should be de-risking and bidding up treasuries. The Supreme Court's earlier decision in validating broader levies had already injected volatility, but this renewed protectionist stance underscores a persistent challenge. Gennady Goldberg from TD Securities points out the initial angst around lost tariff collections and refunds, but the current scenario, with more collections expected, ironically eases some of those specific worries, even as broader uncertainty escalates. This isn't merely about trade numbers, it's about the very fabric of global commerce. Nassim Taleb, the author of The Black Swan, offers a crucial insight here. While tariffs can be effective if implemented predictably, erratic policy effectively removes the incentive for capital commitment. It acts as a regressive tax, disproportionately hitting lower-income consumers and exacerbating inequality. We see this struggle for predictability play out in real time. Consider German Chancellor Merz's recent meeting with China's Xi Jinping. Despite Merz's historical skepticism towards Beijing, he acknowledges the need for patience and dialogue, recognizing the complex interdependencies that defy simplistic political posturing. The dance between economic gravity and political friction remains a delicate one, highlighting the fundamental tension between national interests and globalized supply chains. Further east, in the Middle East, the specter of direct military confrontation between the U.S. and Iran casts a long shadow, driving yet another wave of risk-off sentiment. The rush by Gulf petrostates like Saudi Arabia and the UAE to boost crude exports, reaching multi-year highs, isn't just opportunistic, it's a proactive, precautionary measure, as Richard Brons of Energy Aspects notes, to ensure continuity of supply amidst fears of an American strike and potential disruption to the vital Strait of Hormuz. This is precisely the kind of tail risk event Taleb warns about, capable of triggering a 1970s-style commodity shock that, as he ominously suggests, cannot easily be fixed with monetary policy. Société Générale's Subhadra Rajaput ties it all together, observing that these rising geopolitical tensions, particularly around Iran, are a significant contributor to the ongoing haven bid in treasuries. Beyond these immediate flashpoints, there are deeper, more structural shifts at play. Taleb raises critical questions about the U.S. dollar's status as the global reserve currency, particularly in light of sanctions policy. The perception that assets can be frozen or confiscated erodes the incentive to store wealth in dollars, potentially leading to a gradual de-dollarization at the margin. While a recent Bank of America survey among credit investors suggested that concerns over an AI bubble outweighed geopolitics, we must consider the specific segment being surveyed. For broader market sentiment and long-term strategic thinkers, geopolitics remains the elephant in the room. Trump's year-end shuttle diplomacy, engaging with leaders from Russia, Ukraine, Israel, and China while conducting military drills around Taiwan, illustrates the sheer breadth of active global friction. This constant, high-stakes maneuvering is a perpetual source of market cooling against a backdrop of geopolitical heating. Ultimately, geopolitical tension introduces an uncertainty premium into all asset classes. It demands that investors not only understand economic fundamentals, but also become adept political analysts. The need for hedges, as Taleb advises, becomes paramount in a world where large drawdowns are not easily predictable. For policymakers, it's a constant tightrope walk, balancing domestic pressures with international repercussions. For us, as financial professionals, it means embracing a holistic view, acknowledging that the lines between politics, economics, and market behavior have never been more blurred. The unseen hand of geopolitics is not just guiding market flows, it is redefining the very landscape of risk.